Adam Cochran is an investor at Cinnamhine Ventures, but he's probably most known for his extensive and viral threads on Twitter. So to kick off our conversation, and before we deep dive on the FTX collapse, my first question to Adam is, was he expecting to turn into a meme in the crypto Twitter community for his long-winded tweets?
No, but I started writing the threads just because I've always been writing in long form, and then I realized that they have this extra virality of people sharing chunks of it, but also people hate retweeting it. And they're so angry that the thread exists that they retweet it to mock it, and it ends up spreading it better. And so I just decided I was going to lean into this meme of writing threads.
Yeah, and it's worked out. So Adam, I was just telling you, I'm really excited to have you on this podcast because it looks like you have a really just like a real kind of good sense of what's going on in both crypto and then macro markets as well. So as we're kind of wrapping up at the end of the year, I wanted to get this more kind of eagle-eye view of the market and of the just like spectacular fallouts, catastrophes that we've seen. So just wanted to start with the most recent and biggest one with FTX. We have seen a lot of new information come to light in the past, few days with the hearings, with SBF being arrested, with the charges leveled against him. So I think by now we can start to build a pretty coherent view of what happened and how this, what was supposed to be a really solid exchange fell in what seemed like just a couple of days. And you've been just following this super closely. So I wanted to maybe take a step back with you and see if you can reconstruct what happened at FTX. Like, what was the final drop that made this kind of house of cards collapse?
Yeah, and I think what's interesting there is that for the sake of this story, we've all been focused on what that final drop is. And everybody, the Kevin O'Leary's of the world out there want to paint CZ as this supervillain who pushed FTX over into collapse, right? I don't know if it matters what the final straw was. Like, it doesn't matter what brought this fraud tumbling down in the end. What matters is where it began and how it developed to this tremendous scale. And I think what we're seeing now, despite Sam's best efforts to do this media tour to hide this, to frame this as a mistake, this was kind of a plot point all along. Like, we heard John Ray, the new CEO who's working in the liquidation, his testimony before Congress the other day, saying that FTX had financial challenges going back to the very beginning and was loaning out to Alameda back to the very beginning, right? So we don't know whether FTX was built for that purpose, but we know that it very quickly became about that purpose. And while this may have started off as patching small holes here and there, I think they realized they could get away with it and continue to do it and grow the scale of this fraud. And what is unclear to me still at this point that I really want answered is, were they just embezzling money to enrich themselves, or did they actually believe in their own mantra that they were putting out there of these continuous outside bets where they thought, if we have all this money and we keep on making these bets, eventually we'll hit it so big that it won't matter. And so I don't know if they were just straight up criminals or stupid criminals, right? It's one of those two categories, don't know which. In the end, what really brought it down is they took too many gambles. They lost too much money, and it caught up with them at a challenging time. But that's far less interesting to me than all that stuff in between, how we got there.
So can we do like a step by step of what happened? To me, and maybe this is not kind of the right starting point, but to me it looks like it started with Luna. And because of their structure, where Alameda could just, take these outsized bets without being liquidated, they just they took the wrong bet with Luna, and then this huge hole appeared on their balance sheet. And is that kind of what's really accelerated the fall? Or like, where would you say like this started to snowball?
It could have been what accelerated it. For what it's worth, I think based on what I see on-chain data, and I've not been able to find the smoking gun for this, but I have a hunch that they were actually insolvent during the COVID crash as well. Because we saw a ton of money flow in from Alameda accounts when they had paused or delayed withdrawals during the COVID crash for, I think it was like 16 hours or something like that. There was a delay. And that was the same behavior we saw here at the end. And so I'm not convinced that this was the first time this happened. This was just the first time they couldn't recover from it. When we look at what likely started these dominoes, I do think Luna was probably a part of it, but we know that Alameda was just like, to make sure that FTX had liquidity, taking the other side of every bet. We found out Alameda blew up and lost $1 billion shorting mobile coin or whatever it was that they listed. And everybody at the time was like, who's this idiot who is shorting this and willing to blow out this position? And it turns out it was just Alameda taking the other side of all these, low float bets on their own exchange. I think Luna accelerated that. And I think there might have been some attempts, I'll say allegedly so that there's never any lawsuit about it, for them to purposely set up hostile takeovers of some of these lenders where, they went out to the Celsius and Voyagers and BlockFi of the world and said, here, take our FTT, take our Serum as collateral. We're going to borrow Bitcoin from you. Then we're going to sell down the market, knowing that you are holding something that is super illiquid on your book that you can't possibly sell to recover the debt that we've taken. And knowing that no other buyer is going to look at you at the same value because of how illiquid FTT is. And therefore, we know our bids will be the most attractive bids to take you over. And so I kind of have this hunch that they specifically wanted to buy out those lending entities for their users and their licenses and set that kind of house of cards up on purpose for that component. And then it started to get a lot more out of hand. And there started to be other risks like Three Arrows Capital blowing up, Luna, other bad trades, the macro economy going down. And it kind of spiraled out of control, putting them on this real squeeze. But I mean, we know they've been losing money for years and they aren't the traders that they thought they were. But I think you're right that that's kind of probably where this catalyst began, and it just really got away from them.
So, okay, so it looks like the original sin of Alameda and FTX was that Alameda was allowed to take these margin positions on FTX without having any liquidations, and then FTX started funneling user funds to make up for those losses. Is that kind of the short of it?
I think it might even be worse than that. It might even be more explicit than that. The evidence seems to point to not just like Alameda being allowed to take these margin positions on FTX, but actually able to like withdraw user funds and use those funds in their trades as collateral elsewhere without posting any collateral.
Just like directly taking user funds.
Just directly, like, you go into your account, it says 0 and you say, I want to withdraw 100 Bitcoin, and they still let you withdraw it, right? It is just blatant at that point, right? It's not about margin. It's not about mislabeled accounts or bad risk management. It's just knowing theft.
And to you, the question was, were they doing this to enrich themselves, or was it about we're making all these risky bets and hoping that they'll be successful with one of them and make it back?
Yeah. I guess they were trying to enrich themselves either way, but it's like two different versions. One is I'm going to make risky bets and keep the profit and hope I can return the money without you noticing. And the other is I'm going to buy luxury penthouses and hope I can keep this scam going long enough that I can just live happily ever after in my luxury penthouse, right? Either way, it's out of their own greed and or stupidity.
It's bad. From the recent hearings and documents that have been surfaced by the SEC, by the CFTC, what has been the most surprising to you, or kind of what has helped just like further clarify what's going on?
I mean, I think my hunch from the very beginning was that this had to be intentional, and they knew about it, and that Sam's story about mislabeling was bullshit. But what really cemented that case, I think, is actually the CFTC document, where the CFTC did better research than anyone. They've got chat logs from private chat messages in Alameda talking about the code name that they used to refer to this account where they had all the Alameda money on the back door. And, they labeled it as that one weird Korean account or our Korean friends account. And that was just like a knowing code name for this account. So they knew this was happening. That's the smoking gun that takes this from, oops, I'm just a kid who grew a business too fast and blew it up, to this is a criminal action.
So, I mean, to you, by this point, is there any chance that SBF didn't know that he wasn't?
No. I don't believe there is any chance that he didn't know. Even if he didn't orchestrate it himself. We spent years in this industry seeing Sam know every detail about everything, knowing how acutely involved he was in every process of both Alameda and of FTX. He knew everything that was going on. He would respond to every user on Twitter. He's a smart, detail-oriented guy. We know that. And for him to suddenly say, oh, I didn't know that my business was $10 billion in the hole and lending all that money to my other business, there's no way, not at that scale. That's nonsense.
Taking a step back, what do you think this means for crypto more broadly? I mean, the fact that this happened and was happening for so long, what does it say about the industry? Because, okay, we can argue that this was, an outlier, that it's unlikely that there's just this level of fraud elsewhere. But in the end, this is an industry. It was a structure that was allowed to thrive in the way that the crypto is structured right now. So what needs to change? Like what are the steps that you think crypto should take to prevent this from happening again?
So I have two initial thoughts of this. And first is that this was a crime. It wasn't about crypto. It was just a good old-fashioned fraud, right? Like the first ever documented fraudulent Ponzi scheme in America was about railroad bonds, but we didn't say railroads were bad. Right?
Yeah, of course.
Crypto is just how this was carried out. On the other hand, I think, unfortunately, regulators are going to be using this as a cudgel to bring down strict and nonsensical regulation on this space. Elizabeth Warren is already saying that miners and wallets should do KYC AML. She wants anytime somebody transfers through a miner, which I have no idea what she means by that, that miner should KYC the person sending that transaction, which is just like fundamentally impossible. They're going to use this as a weapon to bring down regulation on a space that they've decided they hate without understanding the technology. I think our job as an industry is actually to show this as a case study for why we need the blockchain, right? If we leveraged the blockchain the way it's supposed to be, these exchanges could be hybrid exchanges that were transparent, where we knew their balances, where we knew the solvency that was going on. We have ways to do proper proofs of reserves through Merkle trees. We have ways to show where the cold wallets are. This fraud can't happen when we use blockchain technology in the transparent way that it's meant to be used. So I think we as an industry need to get better at adopting some of this technology ourselves. And that's hard. Centralized experiences still need to exist. There's still value in them. And it will be many years before we can replicate them fully on chain. But if they do exist, they need to be well regulated and as transparent as possible, and use the technology that we have to display that rather than just saying, hey, trust us, everything is fine.
Yeah, so absolutely. I think making sure that centralized entities and exchanges are as transparent as possible, that they're actually using the blockchain, to prove what they have. That's just like such a clear step to take after this. but like in the sense of just like market structure, it seems like there was just a lot of irregularities happening here too, right? Like the fact that this same company owned both an exchange and a hedge fund. I don't know if there's like regulations to be put in place for that to prevent that from happening. What do you think about kind of do crypto exchanges need capital requirements? Do they need to have some, money exchange licenses so that they fall into the same regulations that all other exchanges fall under? What do you think should happen in terms of like that?
Yeah. It's tough because I understand the intent of a lot of these regulations is to protect consumers. And we see time and time again that consumers do need protecting, right? There's bad operators in this space, whether through malice or incompetency, harm the everyday investor. But a lot of the regulations that we end up building don't address any of the problems, right? Like if FTX had money transmitter licenses, they still could have done this, right? It wouldn't have changed anything at the end of the day. I think there's probably, I don't know if there's a regulatory way to better ensure that. I think that customer demands of market structures become important. Don't support exchanges that use highly illiquid coins as collateral. Push exchanges to lower the amount of leverage they are willing to give you. We don't need 100x. That's bad. And push exchanges to be more transparent with on-chain resources. Because at the end of the day, there was so much risk here. There was so much double dealing between Alameda having preferred access and things like that. But if their cold wallet still had all the consumer funds one-to-one that they were supposed to have, no one would have lost money, right? So this could have been as unlicensed and bad risk setup as possible, but people would still have their money. So I think at the end of the day, that transparency is what's so key.
Yeah. Okay. And speaking of that, moving on to Binance now, because that's kind of the other big exchange that's under scrutiny. Apparently, there's been a multi-year investigation in the works by the U.S. Department of Justice, and it's I think it was just really interesting how that timing happened with Binance kind of maybe pushing FTX over the edge, and then appearing as this like white knight of crypto, and like just like voluntarily showing their proof of reserves and doing all this push. But then obviously they're not so. Potentially, they're not so clean themselves, and they are being investigated. How likely do you see, or what probability do you assign to Binance having an FTX level collapse?
I don't see it as likely, but that doesn't mean you shouldn't take rational steps to protect yourself against that risk. Like if they are fully solvent, there's no problem putting your money into a self-custody wallet for a little while just to be sure. That should be fine with everybody. That used to be standard practice in the early days of crypto. Bitcoiners would kind of organize a run on an exchange to make sure it actually had the assets it claimed to. And so that should be an okay practice. I don't think Binance is spotless. I think they're in this situation where they're good enough. And it's kind of like, it's like having a car mechanic who probably overbills you a little bit, and the quality of the goods may not be perfect, but like you expect that. You're not expecting a perfect service from him, so you're getting what you expect and you're getting what you pay for. I don't expect Binance to be spotless. It's an offshore exchange at the end of the day. It is a low margin exchange, right? In its fee structure, it's cheap. I expect it to be good enough and able to keep my assets secure enough and be backed well enough. I don't know if they're backed 100%, but if there was a collapse, I would imagine they are well enough backed that my assets aren't going to zero, right? Like I've always considered that if an exchange collapses, but I get like 98 cents back on the dollar, okay, that 2% is just like crypto volatility, so I don't really care. And I think Binance is obviously, it's in a different realm than risk of FTX. At least Binance is pointing to cold wallets that are extremely well funded cold wallets. And we don't actually know the full liabilities they have right now or the breakdown of ownership of those cold wallet assets. But at least there's cold wallets and they're massive, right? Whereas FTX had no cold wallets and wouldn't point to any additional wallets and had only, $750 million sitting there out of supposedly billions. So it's an entirely different order of magnitude.
Okay, good. But so where would you say the potential risk is that, okay, they have these massive cold wallets, but maybe they also have huge liabilities that we don't know about? I think that's the big question mark, right?
Yeah, I think that's the question mark with anybody where they have any in-house trading or venture or their own chain. If they're borrowing assets or they're lending out assets, you can get into sticky situations because depending on the jurisdiction, the bankruptcy law and who has primary claim to those assets can get really weird. And so if they've pledged, a bunch of collateral against a massive loan and can't repay that loan, not many countries have a carve out right now in bankruptcy law saying that crypto funds deposited by a user have to go back to the user. Whereas in like fintech, if you deposit into a stock brokerage app, it says that the cash and stocks that you have there must be carved out of a bankruptcy proceeding. They cannot be part of that debt. Most countries don't have that for crypto yet. And so it becomes a very messy legal debacle as to which assets are allowed to be taken by the bankruptcy court. And so I think liabilities is where you get into the concern. I don't think it's likely in this case, but it's hard for us to ever fully confirm. So
yeah, liabilities is a question. And going back to what you said before, kind of the need to be transparent and show kind of on-chain records. Is there a way to do that with liabilities? That's a lot trickier, right? Because that involves, off-chain agreements.
Yeah, I don't think you can do it with liabilities that the company has. You can do it with user deposits of liabilities. You could create sort of a Merkle tree proof of all of the liabilities on the exchange, and the user could then punch in their balance and look that one of the nodes on that tree has their balance represented and sums up to the right number. And therefore, they would be able to more or less prove that it is that total amount of liabilities in user deposits and compare that to a cold wallet. That won't be one-to-one exactly because you'll have different cold wallets, hot wallets, sub-accounts, chains. But if it's in the right order of magnitude, that probably gets you pretty comfortable. There's no way to do a proof like that for, hey, did Binance take on a loan of $600 million from some other party and pledge their equity against it? And if they go bankrupt, that party is going to want to claw back user assets, right? We can't prove that.
Okay. Maybe there's a way to still require for those agreements to be posted somewhere, and even if maybe an exchange or that entity can hide those agreements, but if it's a requirement, then maybe there's some sort of recourse that users can claim later.
Yeah, I mean, or we start to move all money markets on chain, and the way that they're taking these loans is through transparent on chain DeFi, right? That means we have to continue to scale up the uncollateralized lending component. But I think maybe we get there in the next 5-10 years where we could have that on chain and we could know this business is borrowing and has these liabilities.
I think that would be just like the ideal direction for this industry, right? To have everything be transparent and on chain, both assets and liabilities. And that's how we can really get away from another FTX happening. The Glow Dollar is a new stablecoin with a very special property. As its market cap goes up, extreme poverty goes down. Glow donates 100% of its profits to people in countries like Kenya and Liberia as basic income. If Glow grows as big as Dogecoin, it will lift 1 million people out of poverty. With Glow, you can reduce poverty just by holding a stablecoin. It's launching early 2023. Join the waitlist at glowdollar.org/defiant. That's glowdollar.org/defiant. The primary driver behind crypto this year has been traditional macro markets. Crypto markets have been at the mercy of inflation and rising interest rates, and the Fed recently raised rates by 0.5 point. Where does Adam think rates and inflation are headed, and how will that impact crypto?
It was on par with what was expected, and the future curve was actually moved up. They think there's a little bit more to do. And I think some people were shocked by that because they're really looking for a pivot and rate cuts next year. I think people have had a hard time digesting kind of how inflation works and how sticky some subcomponents of it can be. We point to goods inflation and energy inflation and say, look, they're coming down so rapidly, we're getting back towards this 2%. And that's true. But we're seeing now services inflation, which is really driven by wage inflation. People's wages don't get adjusted back down, even if you adjust back down the price of on-demand goods. So that gets really sticky. And then rent inflation takes, 12 months to 14 months to work its way through the system because it's only when we renew mortgages and rent agreements and things like that. So those components get very sticky, but we also have to look at it as that inflation has already hit and that purchasing power has already been eroded. So I compare it to, imagine somebody gained the weight, right? They said, as I grow, I'm going to gain 2% of weight a year. I'm going to go from 100 pounds one year to 102 pounds the next year. If instead they had 8% inflation and go up to 108 pounds and decide that they've grown too much and want to lose weight, not only do they have to stop growing, but they still have that excess weight. They still have that extra 6 pounds of weight that they've added. And they want to lose and offset that. And so that's where the Fed finds themselves. And we know it's a lot harder to lose weight than it is to put it on at any rate. And that's exactly the same with inflation. This inflation rate of change has come down, but the inflation has already hit us. And it's hit us at a precarious time when our economy is going through major macro shifts. And we're seeing a change in the way that we work, in the places that we work, and an ever increasing amount of income disparity. And so I think that leaves us in a very challenging position where we've responded far too slowly to inflation. And there's one cohort of us who are well enough off to not really notice the remaining inflation while it squeezes other parts of the economy quite severely.
So what does that mean for the future direction of rates, and then how that will affect risk assets, including crypto?
My hunch is that they have to be continually this strict on inflation and hold these rates for quite some time before we can get to a regime of cutting. There is too much froth still in the market. We've been trained for many years on this up-only mentality where risk assets have this natural upward gravity, like they're just in the absence of any bad news, the S&P 500 will tick up a little bit each day, right? It gets drawn down by bad news, but it just gets lifted up by perpetual optimism. And that's the regime that we've been in and operating in for a long time, and we want to return to. But I don't think it is an economic reality. I think if we go into a recessionary period, it would be a type that I'm calling like a hidden recession, because everybody who is upper middle class, upper class, makes their living on the stock market and corporate income, they're fine, right? The spending for them hasn't changed too much, and it's gone mostly in parallel with exponential earnings on the corporate side. What we're seeing, on the other hand, is that low-income wage earners are being squeezed tremendously by the costs of food and housing and energy prices, especially in places like the U.S. where cities aren't walkable and they have to drive, and people survive on low-income wages because they have low-cost food compared to the rest of the world. Not healthy food, but low-cost food. Those being squeezed when they're already such a massive part of the American household budget puts the consumer in a challenging place. And it's easy for us to look at this economic data and go, oh, the consumer is strong, they're still spending. They are still spending because they need to spend on food and gas and heating their home. But that spending is more and more proportionally coming from debt and credit cards than it's coming from income. And that will put us in this awkward position where if household debt grows across America, that purchasing power is going to erode and is going to keep the labor market tight because people have debt they have to pay off. So they will take whatever job they can get and look for gainful employment. And when we have a tight labor market with strong job demand, that's when you get wage price spirals that happen that will continue to put pressure on inflation. And it basically becomes Jerome Powell's worst nightmare.
Wow. So, I mean, are we already seeing an increase in household debt? I mean, is this already kind of starting to happen?
Absolutely. We are. We're seeing more credit card spending, and we're seeing the savings that people had during the COVID pandemic be rapidly eroded, right? Some segments of the population still have outsized savings from that time, but many of them are back to almost pre-pandemic levels. So over the next 12 months, unless we have major improvements in the actual underlying economy, we get these transient costs of food and energy to stabilize. We get employment moving stably again. If we don't have that, if we have any more supply shocks to the system, I think we're going to find ourselves in a place where large components of the U.S. market are spending on debt. I think it was back in August, we found 1 in 6 American households were already at least 1 month behind when paying their energy bill. That's a drastic number, and that was in the summer, right? What happens when we get to winter and people need to more reliably heat their homes? Energy costs already go up. Demand goes up. We're in a bit of a tight position here where everything has to go right for this to not get a little bit worse, at least.
Okay, so but what if I get your point that people, the job market will remain tight because people just, need to pay their bills. But if they are taking on a lot of debt and are in a more precarious financial situation, that would seem like it would push wages down. Like, employers might find they're able to do this, and maybe that starts to mean that the just like inflation rate also starts to come down.
So that would be great. Part of the challenge, though, with that is as prices rise, we usually demand more of a wage. America especially has been, and some states especially, have been so far behind in pushing up the minimum wage for decades that there's a lot of pent-up gap between purchasing power and minimum wage all across America. But wages are another part where they're sticky, because if wages were high when you get the job and you sign that agreement, it's very hard for an employer to put your wages down. It happens, right? But it's less common. They will find new people who come in at a lower wage if there is that level of demand there. But it's hard for them to lower the costs of the current employees until they get turnover. The other divide that we're seeing is on low-end labor jobs. Now that demand is moderating a little bit, during the peak of the pandemic, we saw McDonald's offering like $1,000 cash bonus for taking a job because they were so desperate, right? Those are starting to come down a bit, but on highly technical skill jobs that are still in demand, we're still seeing these premiums being paid because it's hard to get that labor because people know how hard it was to hire. So some companies, even if they don't need the people right now, they need them 18 months from now. They're not laying them off. They're not firing them. They're holding on to them as best they can so they don't have to do that job replacement again. And that's part of why, we seem to be heading in the right direction. Inflation is coming down and people are saying, great, in a few months we can get to cost cutting. But the stickiest parts of inflation, they take 18, 24 months to work through the system. And that's when Jerome Powell says this quote of long and variable lag, right? That's what he's referring to. Energy prices and food prices move quickly and they can help mitigate some of this. But that really core part of inflation, jobs, housing, things like that, service industries, they stick because just the reality of the situation is it takes a long time for that turnover to take place.
Okay. And while that happens, you still have, people who need to cover those costs, and so they'll be demanding still higher wages, and so that makes it harder for inflation to just like meaningfully slow, basically.
Exactly. The more divided our economy is in terms of income class earning and demand, the harder it is to balance the labor market with inflation. Because right now we see one part of the economy driving inflation and one part of the economy driving labor demand, and they are entirely out of sync.
Right. So what that means is that, like you said, we'll continue to see interest rates, on the upward trend. And what do you think? I mean, will we see a rate cut next year, or will it be all slowly moving up?
I don't know. I think we can get to a pause. Like I think the rate hikes are going to come down. I think there's a terminal rate of 5 to 5.25 on the super high end, and I think we can start to hit this pause point. I think the rate hikes moving forward will be smaller, so we more gradually get to that terminal rate, and then we'll have a pause. I think inflation really deeply needs to come down to that 2% level and stay there before they're going to be comfortable with cuts. In part because rates are one of the few parts of the economy where things can be subjective, right? Normally, all that matters is the numbers. It doesn't matter how you're feeling about it when it comes to the economy. But if you don't have any confidence in the Federal Reserve's ability to get inflation down, you change your purchasing behavior. Because if you think inflation is going to keep being bad, you take money out of your savings and you spend it more rapidly because you believe goods and services will be cheaper today than they are tomorrow. And that actually makes inflation worse because there is a rise in spending. And this is why the credibility of the Federal Reserve to be able to do this and be able to trust their word is so important. So when they say that, hey, we're going to keep going, and the stocks market and bonds, especially long-term duration bonds, respond in a way that says, no, we don't actually think you're going to get there, that's a big problem for their credibility, and kind of means that they have to come out and maybe overhike and maybe hold that hike rate longer to a point that it damages the economy, because that damage is less damaging than the American population no longer believing the Federal Reserve.
Wow, that's so interesting. Okay, and then if that's the case, that we'll see the rate hikes and then potentially maybe not cuts, but just holding rates at the same level. Do you think that's enough to for crypto to I don't know if like say that there's going to be a new bull market next year, but at least stop the downward trend in prices?
I think once we have clarity on the end point and have worked our way through this whole FTX collapse and the multiple hidden bankruptcies that I think are still out there to work their way through the system, once that's all gone, I think we find a point of stabilization at the very least. I think what we're going to see in a high rate regime will mirror what we see in the stock market during a high rate regime, where value stocks outperform growth stocks, right? So anything that has real recurring revenue, anything that has a profitable business model is going to be more favorably rewarded by the stock market than a growth stock that isn't profitable yet. Same with crypto. I think we're going to come back to things that have real value, real users, real monetary flow. Now, I thought that's where we would be heading this year before Jerome Powell decided to not respond to inflation early, and before a war started in Russia, and before Three Arrows Capital and FTX blew up. That was my thesis for this year, of getting to these assets that have real tangible value and starting to mature this market into crypto not being a single class, but being divided into a growth versus value kind of proposition. We're not there yet, obviously, due to a lot of incredible chaotic events happening all at once. But I think that's probably where we get to in a high rate environment, because when money is no longer free to borrow or free to invest, there's a hurdle, right? You basically have to ask yourself, is the thing I'm investing in worth more than a 5% annual return? And if the answer is no, you're not going to invest in it.
Is that just measured by inflation?
No, that's a majorly oversimplification, right? But there is equations for what is the time value of money. And it's like, if I lock it up today, how much money do I need to earn to offset the fact that it's illiquid, locked up, I have to sell it, I have to take tax losses, and I could be gaining somewhere else, right? And the inflation rate is ultimately the cost, the base cost in the economy to borrow money. And so in the regime we've been in, money's been free. And so it's been hard to find places to put your money, and moves up the risk scale. And it's been cheap and easy to borrow money. The bar's been very low. And that's what led to this 20-year period of, unprofitable tech companies being worth $20 billion, right? Like Uber isn't worth tens upon tens of billions of dollars in a world where the interest rate is 7%. It doesn't make sense. If the interest rate is 0, yeah, sure, right? Because you have to move up in risk to get that level of return, because the risk-free rate is non-existent. So I think that's kind of where we're going to see things go. But it will take time for this to work through the system and for us to get confident in what the terminal rate of the economy is.
Okay, so going back to your recommendations for this year.
Yes, my shopping list thesis.
Your shopping list and your recommendations for next year. So okay, it's interesting now. I kind of understand your thesis a bit better with what you've said. And just for context. So Adam put out a 200 plus, I think, tweet thread in December of last year with his recommendations, like a shopping list of tokens of what will outperform.
I will clarify from a legal perspective, not my recommendations, my own personal shopping list.
Okay.
But yes.
Okay. And there was a God tier, a strong outperform, value, and then, risk on, but potential, and then high risk. And so now I get it. Like your God tier recommendations were based on tokens of protocols that were making revenue.
Yeah, they have cash flow, they have user bases, and that revenue cash flow comes from real demand or real products. It's not a matter of that revenue coming from artificial amounts of trading or just their own token emissions, right? There's a real use case for that. And then we kind of tier it out from there of looking at what has a catalyst to get to real users or real demand, right? Needless to say, this got kind of slaughtered. One of the things that is an important context on the model of a shopping list is you proportionally buy them on dips as the market dips down. And, I've said in this thread, these are things that in many cases I expect I could have to hold for 5 years and deal with 70, 80% drawdowns. I didn't think we would get it that fast. I'll also caveat that the moment Jerome Powell said transitory and the war broke out in Europe, I also said we should short things. And I had advocated that my position would be short things and buy these as spot for my own long-term holding, because you have to react to the macro events. Even if something is catalyst driven. But yeah, there were a bunch of these that were a miss, right? Phantom destroyed me. That was a painful one. But the overall thesis of looking for what in the next 5 years can have real users, real value, and real cash flow external to itself is still the core thesis I believe in and have been purchasing on.
Web3 is weighed down by fragmented experiences, becoming more of an obstacle for users rather than a warm invitation. Core seeks to erase these points of friction. Built by the team behind Avalanche, Core is an all-in-one command center for Web3, supporting Avalanche, Ethereum, and Bitcoin, a rich ecosystem of dApps, Bitcoin and Ethereum bridges, NFTs, subnets, and more. Download the Core browser extension to get started and connect to the Core web to unlock additional features at core.app. So here's a big question. What's the most important thing about crypto? It's not transactions per second. It's not convenience, and it's not even smart contracts. It's decentralization to achieve censorship resistance so we can all be free. Minima is a new layer 1 blockchain designed to run in full on a smartphone. Join hundreds of thousands of node runners on Minima's incentive program today to start earning Minima every day until mainnet launch. Get started at minima.global. The coins mentioned on Adam's shopping list from December 2021 have lost approximately 80% of their value to this day. In comparison, Bitcoin has lost 60% in that time. We talk about the thesis behind the list and whether he's changing it for next year. Separately, Adam mentioned that he had adjusted to market conditions and had been shorting throughout this year, compensating for some of his long positions. So, what were the items on his shorting list?
I mostly shorted on some macro TradeFi as well as the majors on Bitcoin and Ethereum when things really got overblown. And we started to see some cracks here. And my view was I'm going to protect myself with downside protection here on contract basis, and then buy spot in things over time on each major dip on the things that I want to purchase, right? And that's the concept behind building a shopping list, is that when markets crash, they are likely overselling, right? We get these big, 30% drawdowns on a crazy black swan day, and we'll find an equilibrium that's higher than that, but people are emotionally overreacting. That's not the time to go do research, right? You build a shopping list of what has a catalyst, what do I want to own? And then on those days where you get suddenly a 30% nuke, that's where you go buy the spot assets of those, and turn any cash that you have on downside hedged protection into some of those spot assets. And you expect a little bit of rebound and doing some rebalancing on that. And then if you get another outsized day, that's another opportunity to go spend on some of these. So basically, no matter what you're looking at as your thesis, what I can recommend, I can't legally recommend assets to people, but what I recommend is taking the time to develop a shopping list based on your thesis, so that when buying opportunities present themselves, you're not wasting time trying to research. You're going, here's what I believe I want to buy. Here's why. Here it is by tiers of how much I want to allocate to it. And now I can seize that opportunity better.
Do you create rules for yourself for when those buying opportunities happen? Because otherwise it seems like, it can be pretty arbitrary. And I think there's like a lot of documentation about trying to time the market, how it doesn't work. So it's like, are you like, okay, every time there's like a 10% drop, I'll buy? Or like, what kind of rules do you have in place for that?
So if I don't feel that the market is frothy, I will have some sort of small dollar cost averaging automated purchasing on a lot of these assets just ongoing. If I feel the market has gotten too frothy and overextended, I'll pause that for a while and then get it back after a drop. Then based on each of the tiers, I usually look at what are the average annual down days, what are the big down days that we expect. Maybe the average volatility is a 5%. And so if we get a day that is a 20 or 30%, those are my shopping days. We kind of figure out what are those outsized ones. And I have to keep liquid enough and keep in a position where I am comfortable with an 80% drawdown or holding something for 5 years, because that's the reality of this market, right? You have to be prepared for that. But really looking for those outsized days to kind of step in and buy the spot and rebalance between any downside protection you might have.
Got it. Were you able to compensate the 80% drawdown of your shopping list with some of your short positions?
Yeah, and the 80% drawdown is if you bought all those things at the time, right? Which is not the purpose of a shopping list. I had some of those assets, but I was still in short and in cash and buying into these assets over the course of this year, because that was the 2022 shopping list. And I'm still buying many of them now. And I suspect that will also be in a position. There's a whole bunch of them that are no longer on my list. And that's to be expected, right? You want a few of these to outperform as we start to pivot and go back up and be long-term holds. And it's the same game as VC Moneyball, right? You expect if you can get one that is 100x return, that can offset 99 bad choices. VCs don't need to be right 51% of the time. We just need to be really, really right when we are right.
Exactly. Yeah. Okay. So just for those listening, I'll just name the God tier. It was ETH, Wi-Fi, that's the Yearn token, Convex, and Keeper. Are those still in your God tier? And like, how else has your shopping list changed?
I'm going to be doing a full review of the shopping list and an updated one at some point. I just had my first kid a few weeks ago, so there's far less time and sanity in a day than I expected to have. But I'm going to be revisiting that for the new year and kind of revising on my thesis. Ethereum is absolutely still in the God tier. I think Convex is as well. Yearn, I believe, still in exactly where it's going and what they're implementing. It took them longer to get there, and they are definitely stronger in a bull market. But they're one of the few services in this space that drives real value and real revenue at a tremendous scale. And so I think long term they are still there. Keeper, I think, had fantastic potential. Then Andre rugged and disappeared from the space. And that was one of his projects. And so it took them many months to kind of get handed over to new management and a new direction. And I'm still excited about it. I don't know if it would quite make that same tier. It's definitely still on my radar because I think the automation of execution logic is one of the few business to business services that exist in crypto. And that means you can create recurring value, actual cost value, bring in real revenue from other businesses by automating logic execution. And I think that's so critical if we want to be truly decentralized. We need to stop having things run by DAO multi-sigs and waiting for people to execute transactions. We need to automate that infrastructure. And no one is doing that with the level of clarity and automation that Keeper has been. So I think there's still a lot of potential there. I don't know if it would quite make that same tier for me right now.
Okay. So what other, I don't know, it doesn't have to necessarily be specific assets, but, sectors, themes, are you excited about, and which are you less excited about than, this time last year?
Mm-hmm. I think I'm way more excited about privacy execution than I was. I'm very excited by the things actually in the Zcash community where they're starting to talk about how do they take their chain to support other assets other than just having Zcash on there, right? So we'll be able to eventually move Ethereum tokens onto Zcash and do private transactions with them. And I think that's critical. I think privacy is something drastically missing from this space that we deserve in modern finance, right? We have to have privacy. I'm less excited by other L1s, not because I don't believe in other L1s. Many years ago, I wrote this thesis of the OSI model of the blockchain, where I think alternative chains outside of Ethereum can have niche purposes that they're optimized for and work together to improve the blockchain space, just like the internet has www and it has email protocol and FTP and all these other things. I think you can have specialized L1s. What I'm not happy with yet is bridges. And I think until you have maybe like ZK-proofed bridges that are irrefutable proofs, I don't think we can safely get to a multi-chain existence. There's too much reliance on centralization. And I think I overestimated by a few years how big that gap was right now. And so I'm less excited about other L1s right now today. Increasingly excited about the technology around L2s, although not the economics of L2s yet. I think the best L2s will follow an optimism model where Ethereum is the base payment that you use. I don't see there being a good token model there for distributed holders until we have decentralized validators, which I think is very tricky. So I'm not excited about those as tokens yet necessarily. But my excitement still remains focused on things that drive real tangible value. I don't care about the hype in the gaming space. I want to see things that are real users with profitable external revenue. And projects that I've contributed to over the years, like Yearn or Synthetics, I'm very excited for what they're building because they're so focused on that real value premise.
Okay, super interesting. So you this thesis of growth versus value still holds. Some of the differences is in kind of which areas you think will be driving that value. It looks like you're mentioning synthetics and Yearn. It seems like Ethereum-based DeFi is where you think a lot of the value will be built. Is that right?
Yeah, I think Ethereum-based DeFi, I would love to see new models emerge. One of the projects I find most exciting, not from a financial gain point of view, but from just a use case, is POAP. I love the collectibles. I think that's great. I would love to see that continue to expand and the use cases mature. I would love to see other use cases. I just don't think we're as developed. We have 5 or 6 years now of history in the DeFi space getting to that level of maturity where it's kind of more ready for mainstream. So I think that's interesting. I think there's some interesting stuff in GameFi, but maybe 1 or 2 businesses, as opposed to many people thinking the whole GameFi thing is a hit. And definitely Ethereum-based, EVM-based for me still. I think there's other interesting things out there, but I think there's just such a critical mass to Ethereum and to Solidity that even if you build something better in some way, it doesn't necessarily mean it's a fit, right? Like VHS still won out over Betamax, even though Betamax was a better technology for videos at the time. We still used VHS because it had reached this critical adoption point. And I think Ethereum is there and continuing to improve upon those things. And so it still ends up being the volume leader and the user-based leader in these things, and where a lot of the core innovation happens. A lot of other chains just have forks of things that were made on Ethereum, and origination doesn't start there. And I think that spark of ingenuity that is attracted to Ethereum because of its value-driven origin, I think that's an intangible that's almost impossible to replicate or replace.
Yeah. And like you said, I think there was a lot of disappointment over the promise of a multi-chain ecosystem this year with all the exploits to bridges. I think that was kind of the thing that just, I don't know if it killed is the right word, but at least made less appealing the alternative L1 thesis. Yeah.
I think for me, it wasn't even just the matter of all these exploits, but that we were so focused on sending money across bridges. And I think if you want a real multi-chain future, you need to be able to better send data across bridges, like read and write data. I should be able to read a value from a contract on another EVM compatible chain on Ethereum in a smart contract call. And I know Chainlink is exploring some of that stuff with their upcoming releases. And so I'm excited to see how that goes. Because I think if we can send data reliably between chains the same way that we could back and forth between Ethereum and an L2, but do it faster than the 7-day timeline, that'll become really powerful, because then we'll be able to use other chains that are optimized for data storage or optimized for execution speed and still relay that information back to Ethereum in an affordable way. And that'll open up a lot more in terms of design space in Solidity.
Yeah, no, that's a great point. Okay, and then wrapping up, I'm thinking about kind of getting your view on just like this next year and whether, we talked about where you think macro is going. So do you think it'll be, just we'll continue more or less trudging along kind of sideways? We'll, hit a bottom, then maybe continue sideways in crypto. And do you think we'll continue in this bear kind of market where all of these applications and protocols just will have to keep delivering value? I don't know. Where do you see this space going, basically?
I mean, I would be okay if we never have another frothy growth market. They are exhausting, and we get so much spam and so many hurt users and so much bad regulation every time we have a major bull market. I'd be totally fine if we just pump out value for the next few years and grow slowly but steadily. That wouldn't sounds be bad. Great. Yeah. And I still hold the premise that 5 to 10 years from now, blockchain will be as ubiquitous as the internet. Right? This is the moment where, in parallel to the internet, this is the just after the .com bubble, and we're kind of walking through the wreckage and there's all this regulation circling the space, and things look pretty bleak. But that doesn't change the trajectory we're headed on or the things that we have created here. I think there is still this inevitable future that the blockchain has. And so I'm as bullish as ever and as confident as ever on the long time horizon. Short term, I don't know that we have the catalyst to start another bull market anytime soon. I lean towards the fact that we have not bottomed in TradeFi. And therefore, I don't know if we've bottomed in crypto, maybe because we oversold a little bit on the 3AC blow up. But that's also hard to tell. There's still a lot of unwinding there that could take another 6 months of private book value being shifted off. And so I don't know if we solve those problems right away. Maybe we hit some sort of catalyst. Maybe the war in Europe ends. Maybe markets stabilize. Jay Powell gets a soft landing, and we get a new kickoff of excitement as we make huge leaps in ZK proofs, and everybody's using Ethereum-based L2s on their phone, super cheap and super fast, and it's awesome. And we all go to the moon again. Maybe. It's entirely possible. I think my more conservative view on it is that traditional markets probably bottom sometime in Q1 of this year on earnings revisions. Maybe the S&P looks for a 3,200-ish again. And that should probably be the bounds limit where crypto is kind of bottomed, unless regulators take this opportunity that FTX has handed to them to slam down the U.S. market. And because the U.S. market is incredibly lucrative, and regulators have a tendency to overreach. And that could set us back a few years if that happens. But even if they ban it, other countries in the world get there's value in adopting this. And I think from a competition standpoint, America will eventually realize they are lagging behind and reverse any such decisions. But that doesn't mean they can't make the bad decision in the meantime. So I know that's not a clear answer, but I am infinitely bullish in the long term and hesitantly cautious about this. You know, everybody says, oh, we've already bottomed. This is it. Up only. We're great. Exercise some caution in that. And know where you want to be long term is kind of my perspective. I think there's still great opportunities here. You just have to be okay with weathering any storm that comes. And if you can plan for the worst risk and things go better, that's a great position to be in.
Yeah, and I think what you mentioned before about looking at the fundamentals again, you know, what's actually driving value, what has revenue, what has users. It seems like that's the safest bet you can make.
Yeah, what has users with real external revenue, right? Because I think we fell into or many people fell into this trap of like, oh, walk to earn, and it has millions of users earning money by walking. And it's like, okay, but where did that money come from? Why is that relevant? Oh, they're going to buy shoes with it. They're not going to buy hundreds of millions of dollars of shoes that they earned from walking that nobody's paying for. That wasn't going to be sustainable. And that froth is so bad. And I hate when VCs are like, look at my portfolio company that has 60 million users. You know, you need to buy this token. And you're like, who cares? Those users are not adding any value to anyone. Right. And so I think real users with real revenue that isn't just this internal Ponzi is absolutely critical. And we'll do ourselves not only a favor economically, but improving our stance with regulators when we build real things with real value rather than these overhyped, fluffy, walk to earn, play to earn things that collapse in 6 months.
Absolutely. Yeah, I can't wait for all the fluff to finally go away as well. And then final question, you know, this is something I ask all or most of my guests. Adam, do you consider yourself defiant? And if you do, why?
Defiant, intriguing. I mean, I guess in the sense that, you know, I didn't land in a traditional job, and I think that this space is counter to the mainstream approach. You know, I started actually working in crypto full time in 2013 when people didn't know what Bitcoin was. And it was based on this principle of our monetary systems are broken. They're exploitative and filled with middlemen. And the only way we solve society's major problems is having better sovereignty, transparency, and access to our monetary systems. And that's the view that's kind of always brought me back to this space. And it is defiant of our traditional view of, hey, let's build big banks that have to have 90 licenses and put your money in a vault on Wall Street, right? Like, I think the counterculture origins of this space are critical to its future, and they are values that we cannot afford to let ourselves forget.
Absolutely. I think this year has really highlighted that. I think maybe crypto lost a track of these values a little bit, just allowing too much centralization, too little transparency, overlooking kind of the on-chain aspect of it, which is, what makes blockchain revolutionary in the first place. So yeah, I think we'll hopefully, if something good comes out of all of this wreckage, is a return to the original crypto values.
Absolutely.
Adam, it was such a pleasure. Thank you so much for spending this hour with me in the middle of, your new parenting duties. Congrats again on that. And yeah, again, thanks for the really interesting conversation.
Thank you as well. It was an absolute pleasure to be here.